So today I'm going to take you through a couple of examples of market interventions. We're going to define what interventions look like, who usually takes or conducts market intervention, and then we're going to look at two examples of market interventions that were or are partly responsible for higher healthcare costs in the United States. So let's begin this. So, first of all, what are market interventions? Sometimes governments may intervene in markets to facilitate competition, protect consumers, pursue political goals, or even achieve national policy objectives. Private enterprises may also make choices that distort markets, especially through the third party payer mechanism. Although there are other ways that private individuals can distort markets, including through illegally collaborating to short sell stocks, for example, or using stock buybacks to prevent the price of a stock from hitting a certain value. So, well, while we will be focusing on one way that private enterprises can usually do this, there are a few different ways that private enterprises can intervene in markets. So, what is a third party payer mechanism per se? Third party payer is anybody who is not receiving or providing a good or service, but ends up paying for the cost of that. So, for example, an insurance firm is not receiving medical care. They're not providing medical care, but they are paying for the cost of medical care. In some ways, a scholarship, right? The people providing the scholarship are usually, or in some cases at least, couldn't be the people who are not providing the education. So they're not providing the education. They are not receiving the education either, but they are paying for the education. So these are both examples of a third party payer, someone who is not one of the two original parties participating in the transaction, paying for that transaction directly. And when we say third party payer, you can think of some ways where costs can be externalized to third parties, but that wouldn't necessarily be considered a third party payer. Third party payer is usually consenting actively and consciously in paying for a good or service that they're not receiving. So what are some reasons why market intervention may occur, or why even a government may intervene in a market? There are some good reasons for governments to intervene. For example, to improve information, which could mean to ensure that prices capture all costs and benefit of a product. So a government may try to institute a tax of some sort that technically does distort the market as far as increasing costs for a good or service, but that tax may be making an attempt to capture an externalized cost that isn't necessarily captured in the price of the product. So, for example, a few local governments have instituted cigarette taxes, which in some ways are meant to capture the externalized costs of dealing with the healthcare consequences of chronic smoking. You could also say similarly for excise taxes usually placed on alcohol. A carbon tax, which is a strongly debated environmental tool or environmental conservation tool, a carbon tax would try to tax the amount of, or put a value on the amount of carbon being released by a private enterprise in an attempt to capture the costs of that carbon that are externalized to others. So these may be reasons why a government may intervene to improve information or to make sure the price captures actual value of a good or service. They may want to also improve the infrastructure, so making sure that the infrastructure that, for example, the various stock markets operate on is actually safe and secure and high functioning. They may also want to work on infrastructure in other areas where you can see, or I shouldn't say they may want to work on it, I should say there are other areas where infrastructure is a problem in some markets, and you could say that in part for what happens in the Bitcoin market, and as far as who coins accumulate to and whether or not the price between distributors or currency converters is always fair and normal. Government may also want to intervene to improve security and enforcement. So, for example, a government may intervene in a market such as, let's say, well, across the United States right now, the marijuana market is technically on a federal level legal, but perhaps for a local state, if they even just legalize marijuana, they may want to take the next step of putting in regulations that ensure that marijuana being distributed on this market is safe for consumption, is actually properly labeled so that people understand what they're consuming and what strain they're consuming. They may also want to place costs on firms in the form of requiring them to have certain levels of security and requiring them to personally enforce age restrictions. So these are a few reasons why governments may usually intervene in a market, some good reasons. Some reasons why private enterprises may choose to be third-party payers. Now, this gets a little bit more complicated, but bear with me. It does make sense. So they may become a third party payer because they have an expertise in scaling up on and hedging against risk. So scaling up means that they have an expertise in accumulating risks, right? Basically buying risks or risky situations off of people so that they have a scale on the risk. They have a large amount of risk that is very similar. You could even say homogeneous. Maybe it's all risk in a similar area, all flood risks, all motor vehicle risks, what have you. The point is that the scaling of all these risks allow a firm to specialize in betting against that risk or hedging against that risk. The theory, at least the base theory being that on the surface, right, everybody shouldn't experience the same risk at the same time. It's very unlikely that everybody will get flooded at once in a situation unless you only provided flood insurance in a very specific area. But also in the case of, like, for example, healthcare, right, and medical, paying for medical bills. You may specialize in providing insurance for the medical field because your firm is aware of good ways to bet against medical care costs or to invest the money that you're getting from people who are paying for insurance into investment vehicles that benefit whenever medical costs do increase or whenever medical costs are more frequent in an economy. And that would be the hedging against the risk part. That by having such a scale of all these risks, having a large amount of these risks that are very similar, you can create a strategy that prevents you from actually being in a risk intense position. So that even if some people do fall victim to whatever risk they've been looking for insurance against, you're making enough money betting against those risks or betting in a way where you benefit when those risks happen that it doesn't matter anytime somebody needs to claim in their insurance. Another reason is because there is usually a high value to avoiding the risk. So I've been talking about floods, medical emergencies. Those are things that people will be willing to pay somebody to avoid the risk of suffering themselves, right? It's not that people may get sick frequently as much as our fear that when we do get sick, it'll be very expensive and very traumatizing experience for us that may disrupt our ability to make money, may disrupt our way of life otherwise, may disrupt our ability to have liberty and freedom. And we are willing to pay someone to take at least the financial cost of that risk off our shoulders. Similar for flooding, it may be relatively low frequency event, but the risks of the damage caused by flooding would be enough for someone to perhaps want to get flood insurance. So here we have some good reasons for intervening in a market, especially from the government side, and some good reasons for being a third-party payer. Let's look at these two examples now and see if they kind of match up or align with these reasons. So our first unfortunate market intervention consequence, health checkup abuse. So health insurance companies offset a large part of the costs for one of the most common yet likely ineffective services, the annual checkup. Mounting data suggests that annual checkups are ineffective at reducing all-cause mortality. So when you look at samples of people, two different samples of people, and you look at the sample that goes for checkups regularly and one that doesn't, and otherwise these samples are comparable, what you tend to find is that the ones going for checkups are not reducing the likelihood that they will die within a certain time span. At the same time, there's some evidence suggesting that checkups drive up overdiagnoses. You can consider the kind of the behavioral idea or the behavioral issue of going to see a specialist for something and then expecting that the specialist should find something, and if they don't find something, wondering if your money was well spent. So going to a doctor, there is some implicit pressure in that relationship that you're going to this doctor with the hope that you don't find something, but realizing that if nothing is found in your checkup, that you may actually be wondering why you went to the doctor, or if you even need to go to the doctor as frequently. That creates a perverse incentive for doctors to diagnose things that may not be as clear in their tests, but are covered by insurance. They may also diagnose things that are really there, but are not necessarily a problem for the person, in the sense that if they weren't diagnosed for this issue, they would not have been any worse off. There's also the possibility that they could diagnose you for something completely correctly. It was absolutely right that you should have been diagnosed for this thing at this point, but the treatment at the current moment is more detrimental to your health than treatment that would be available if you had received this diagnosis later on. So there have been cases where people who have been diagnosed for a disease have received the treatment protocols or programs that we know today were more harmful than beneficial, if they were beneficial at all. And of course, finally, evidence suggests we consume too many annual checkups. And a lot of that is because patients don't pay most of the cost of the checkup. So how do we come to this conclusion? Why is this case study actually an example of a market intervention consequence, or an unfortunate market intervention consequence? Well, first, we want to understand what a price ceiling is, because that's what we're going to be looking at first of all with the health insurance example. Price ceilings, and why do they exist? Well, a price ceiling is a point above which the price of a good is not allowed to rise. That point can be enforced by law, or by a third-party payer, or just by some sort of action from anybody not involved in the market with the intention of enforcing this price point. So in our case, we have a price point for annual checkups. For a lot of insurances, it usually is somewhere around $10 to $20 per visit. And the idea here is that the third-party payer is ensuring that no matter what the actual cost is of the services you receive during that checkup, you will only end up paying around $10 for it. Why do these price ceilings exist? They exist because governments may find the rising cost of some goods or services, like housing or healthcare, politically or economically undesirable. Ceilings can also be a byproduct of firms offering services that insulate customers from risk, i.e. health insurance. So price ceilings typically exist or are enforced because we just don't like the idea of this good or service going above a certain point. Now, it's not to say that it's always going to be something political. In some cases, especially in the example of a short seller who is hoping that the price of a stock will go down in the near future because that is a bet that they've made in the market, they may be incentivized to get other people to sell shares of the stock just to keep the price down. That's not necessarily political, that's a profit motivation. But there are a lot more cases of price ceilings that involve housing, for example, or transportation services that are really just meant to insulate voters from the true cost of a service, or from having to make the decision of how to otherwise finance that service. In this case, we're going to be looking at a price ceiling that is largely enforced by a third-party payer, and that enforcement is meant to insulate the customer of the insurance, the buyer of the insurance, from the full cost of the service. So in this supply and demand model that we're looking at, we have our y-axis that has the price per visit and our x-axis that has the number of physician office visits per week. So we're looking at the relationship between these two variables. And what you can see is that there's a natural equilibrium at point E that represents $30 per visit and 1 million physician office visits per week occurring. This is what would occur theoretically in our non-distorted or our market without market interventions. What happens though is that there are insurances that get involved who realize that some people may not like the idea of paying a full $30 for a visit, or otherwise may not be able to afford $30 for a visit, and that this insurer can make more money by promising visits that are cheaper while collecting a certain amount of a certain fee each month from the people buying the insurance. So in reaction to that realization, the insurer may offer a service where they will provide the people buying the insurance the benefit of only having to pay $10 for every visit that they make to a doctor. Well, that changes the dynamics in the market, right? Because it's not just the fact now that people are only paying $10 for their visit. That pushing down of the price point to a level below equilibrium actually ends up increasing the amount of demand for this service. So by pushing the price point down to $10, the demand now increases from 1 million physician visits per week to 1.5 million physician visits per week. And you can see that where the demand line, the blue line, intersects the $10 point, you have this gap between the supply and demand curves, right? So the first gap is the gap on the x-axis. You have this gap between how many visits or how many doctors would be able to provide a visit at $10 per visit versus how much demand there is for doctor's visits at $10 per visit. So there's already this imbalance in how much would be provided versus how much is in demand. That gap has to be closed by actually paying or offering a cost, or I should say offering a compensation for the doctor's visits high enough to incentivize enough doctors to enter the market to provide the 1.5 million visits per week. And that's what you see happening on the y-axis side of this orange rectangle. The point between D1 and the point F is $40, right? So that difference between the $10 and the $50 at point F on the y-axis would be $40. And that represents the amount, or I should say represents the difference between the amount paid by the person who has bought the insurance versus what the insurer will pay. The insurer will pay a full $50 to the doctor or per visit to the doctor to incentivize enough doctors to enter the market to provide the 1.5 million visits. The patient would only end up paying $10, which would go through the insurer and basically make sure that the insurer only ends up paying $40 per visit. The first question may be, why would the insurer do this? Because obviously the insurer is now paying more per doctor visit than they would have at equilibrium. At equilibrium, again, remember, the price per visit would have been $30. The mathematics behind this or the profit model behind this would suggest that the visits to the doctor would still be infrequent enough compared to the fees collected from the person paying for the insurance, that the $40 per visit is still factored into the cost of having this customer. And even while factoring in that $40 per visit into the cost of the customer, the insurer is still making a profit margin. So even though the insurer's activity has actually increased the cost of a doctor's visit from what would have happened in a non-intervention market, the insurer ends up better off, and more people end up consuming these visits than they would have normally if they were paying for the full cost of the visit. So there are some videos that illustrate some of the issues with the annual checkup as far as how effective it is for detecting diseases and for preventing early deaths. I'm not going to go into playing both of these videos, but if you download the PowerPoint, I strongly suggest that you play the videos to get a better idea beyond just what I'm saying, why the annual health checkups are problematic as far as insurers effectively inflating the cost of these annual checkups. The second unfortunate market intervention consequence comes from mass dairy consumption. So we have our second case study, mass dairy consumption jeopardizing the nation's health and our environment. The U.S. Department of Agriculture's Dairy Checkoff Program encourages the consumption and export of U.S. dairy products. Its federal milk marketing orders, the FMMOs, provide price floors for milk. And its milk donation reimbursement program, the MDRP, subsidizes milk farm donations for anti-poverty initiatives. Strong evidence suggests dairy is causally related to the nation's most lethal diseases, including hormone-driven cancers, breast and prostate in particular, obesity, diabetes, and cardiovascular disease. U.S. government officials know that many residents are lactose intolerant, particularly people of color, and data suggests these people may also be disproportionately represented in those same anti-poverty programs. Dairy and beef cattle are some of the most environmentally unfriendly animals to raise, contributing to animal agriculture's driving role in climate change, predominantly impacting coastal communities of color globally. All of this will point to the issue of having milk, dairy, cattle subsidized by U.S. tax dollars as a perverse incentive in an environment where healthcare costs are already increasing. And there is plenty of evidence connecting the consumption of milk and beef, to be quite honest, to the perpetuation of some of the leading causes of death within the United States and the cost of treating those leading causes of death before they actually do result in death. So what we'll be looking at here is the concept of a price floor. So we'll look at what a price floor is and why do price floors typically exist. A price floor is a point below which the price of a good is not allowed to fall. It can be enforced by law or by government purchases. It can also happen through private behavior or interaction. So, for example, a firm could buy back its stocks in an attempt to keep the price of the stock from falling below a certain point. That firm would be effectively creating a price floor for its stock price. Even though it's not a government, it is effectively creating that price floor because by pulling the supply of stocks out of the market, it's ensuring that there's some level of shortage that will bring the equilibrium price up. Now, why would price floors exist? They typically exist because governments may find the falling costs of some goods or services, like agricultural commodities, such as milk or sugarcane, politically or economically undesirable, and some powerful industries use their political influence to seek subsidies. So very often the price floor situation is a situation of trying to insulate producers from the actual market evaluation of the value of the good or service that they're producing. And governments may do this to try to prop up certain industries that they deem to be either national security priorities or political priorities. In any case, it's an example of a market intervention that can have some distortion effects. So what you're looking at here is a theoretical supply and demand market for milk. The price of the milk is theoretically on the y-axis, quantity of milk theoretically on the x-axis. And what you have going on here is that there would be a natural equilibrium at P1Q1. So price level 1, quantity level 1. And this natural equilibrium is clearly lower than the price floor that is designed for the market. So the price floor is the point PF, right? And at PF, we have a surplus of milk on the market. So in this example, let's say the government has enacted some sort of program to try to keep the price of milk at a certain point. PF would represent that point, and by keeping the price of milk above the equilibrium point, there is a distorted incentive for more milk providers to enter the market than would have normally happened, or for more milk to be produced than normally would have been produced. And that incentive, along with the disincentive from a higher price for consumers to consume the milk, would lead to a surplus in milk on the market. And that's what you see as the difference between point C, which is the amount of milk that would be demanded at that price level F. So point C traces down to Q demanded, right? And traces over to price point F. At price point F, you would only see C quantity of milk demanded, compared to point A, which, being to the right on the x-axis, is a larger number. That means that there's a larger amount of milk being supplied in the market than would be supplied at equilibrium, and is more than what is being demanded in total from the market. So that difference is a surplus, and that surplus has to go somewhere. Specifically, it gets consumed by your tax dollars. So this surplus is something that we've had in the United States for a while. As you can see from this graph here, we have production of milk in the U.S. from 2011 to 2016 at about 200,000 million pounds per year, and has been steadily increasing from the high 100,000s to the low 200,000s. Consumption has always been at a gap, with consumption in the U.S. being closer to 50,000 million pounds a year and declining since 2011. That, though, has not stopped the pouring of tax dollars into that gap, and that is exactly what that gap represents. The difference of about 150 million pounds of milk is being effectively purchased up by your tax dollars. This graph illustrates the point in a different manner. You can see that milk consumption in the U.S. in pounds has been on the decline since the turn of the century, although a lot of that decline has come from a reduction in the consumption of skim milk and flavored milk as well, while whole milk has seen some part of an uptick. In total, though, the consumption of milk in the U.S. has been dropping to around 50 billion pounds per year. Compare that, and specifically that 2017 number was 49 billion pounds. Compare that to the 2017 production value, which was 215 billion pounds, which is that larger black square over the blue square. That difference is the surplus, the difference between how much is being demanded in the market versus the incentives being provided to producers to create that much product. And that incentive has been difficult to measure, but is probably very large. One estimate puts the total dairy program subsidies in the U.S. at around 6.1 billion in total from 1995 to 2019. That estimate's probably on the low ball. We have some estimates that suggest that the current system of subsidies cost taxpayers around 4 billion per year, rather than just a 6.1 billion over several years. Regardless of the cost, it's clearly an inefficient use of tax dollars for a few reasons. So there's some clips here that are really videos, but I'm going to take you through the ones that are more data-driven tables. So first thing to look at is the global. Actually, let's look first at lactose intolerance and health report. What you can see is that this lactose intolerance and health report was submitted to the Agency for Healthcare Research and Quality at the U.S. Department of Health and Human Services. And without going into the depths of this report, there are multiple points within it at which it's noted that there is a significant amount of lactose intolerance. Here they describe it as LI, lactose intolerance, that is higher in African American, Hispanic, and Asian and American Indian populations. So you can see here just one line, just looking at the results page, one line here says, for African American, Hispanic, Asian, and American Indian populations, LI rates may be 50% higher in late childhood and adulthood. It's not unusual or new information for the US government that lactose intolerance may be prominent within the population. So actually what we have here is a global lactose intolerance by country. And what you can see here is that there's a noticeable increase in the shade on this heat map of lactose intolerance within countries as they move closer towards the equator and further south. You can see that the Western nations almost uniformly have rates of lactose intolerance that are below 50%. There are only some select countries in the Mediterranean and Eastern Europe that have higher lactose tolerance rates. In the United States, the rates look like they're closer to the 5% area by the shading, but a lot of that is due to the diversity of the population here and the fact that this is looking at an average rather than its select ethnicities. But if you were to even just track the diaspora of immigration in the United States back to origin nations, you would see that a lot of those origin nations in Asia and Africa and even in some parts of South America that have been measured all have very high lactose intolerance rates as far as this 2017 meta-analysis of prior studies goes. So this lactose intolerance isn't something that would be necessarily new to members of the federal government or to elected officials. At the same time, though, there continues to be a heavy amount of subsidization of dairy production by the USDA. You can see here there is the USDA Agricultural Marketing Service, and just to show this is not just something that is being materialized here, they explicitly show that their key activities here to help the industry market U.S. dairy products worldwide by providing international groups and services, provide buyers and sellers with impartial evaluation of dairy equipment, develop economic analysis plans, provide information to assist dairy businesses in the production and processing of milk and dairy products, and to administer the milk donation reimbursement program by reimbursing milk processors for eligible expenses for donating milk to eligible distributing organizations and that are distributing to low-income individuals. In later sessions in the class, you'll realize that the pattern of inequality and poverty in the United States implies that these low-income individuals are going to be predominantly individuals of color and individuals living in cities. On top of that, finally, I want to show you the global estimates of emissions, just to show you how starkly different the emissions for dairy cattle and beef cattle are compared to even other animal agricultural products. And we can see here the million tons of CO2 produced. Beef and dairy cattle both produce nearly 4 times as much CO2 compared to pigs, chickens, and other kinds of poultry. A lot of that emission, it comes from the land use that is necessary for raising dairy and beef cattle, and the absence of the ability to use that land to do other activities or to grow other things that would actually be a net positive on CO2 in the environment. So all of that to make the point that despite an understanding of the link between this product and poor health outcomes, especially poor health outcomes for communities of color in particular, there is still an insistence by the U.S. government to subsidize these milk products because it is politically advantageous, especially for some representatives and members of Congress, to insulate producers in their districts from the artificially lower, or I should say, to artificially insulate them from the lower demand for their product in the market because of the amount of influence that these producers have in their select districts. So what you end up having is a political environment where the producers are insulated and protected, even though their products are clearly contributing to negative health outcomes for Americans. So we just went over two distinct market interventions that can be having, or that are likely having, a negative impact on healthcare costs in the United States. With costs climbing still, right, these don't necessarily explain all of the drivers of the higher costs of healthcare in the US, nor does it necessarily explain why every dollar spent on healthcare in the US is less efficient than dollars spent in comparable countries. But this does give you an idea of how market interventions in the form of health insurers who are subsidizing procedures and treatments that aren't necessarily effective, from that type of market price ceiling intervention all the way to price floors in some agricultural products that are meant to help promote business and promote job creation in certain areas, but really just lead to a flooding of the market with food products that may be deleterious to people's health, and the exporting of those food products to other nations. You can see how that would possibly be against the intention of what we would want from a federal government as far as ensuring everybody's health and safety, and at the very least not making conditions in a market such as the market for healthcare worse.